Here's the question nobody in Washington or Beijing wants to answer directly right now. Is the United States and China trade truce actually holding, or is it just the surface of the water, while the current underneath has already changed direction? The White House called the deal done back in June. The Ministry of Commerce in Beijing called it a first meeting, a framework, not a resolution. Two of the most consequential economic actors on Earth just described the same agreement in two completely different ways. And if you own silver, that gap between their language is not a footnote. It is the entire trade. Because silver today is not just a monetary metal reacting to sentiment, it is sitting directly inside the same licensing architecture Beijing built for rare earths. And that changes everything about how the next escalation would actually hit price. Stay with me, because by the end of this, you will understand exactly which lever gets pulled next, and why most coverage of this story is looking in the wrong place entirely. Let's ground this in exactly where we stand right now. As of Friday, July 10th, 2026, spot silver is trading at $60.32 an ounce on Trading Economics data, referencing COMEX futures, up about 0.62% on the day. That single-day move is deceptive, though, because silver is still down over 10% from a month ago, even after being up more than 56% year over year. On June 13th, Beijing's Ministry of Commerce issued a formal statement expressing what it called strong dissatisfaction and firm opposition after the United States added additional Chinese biotechnology firms to restricted federal contracting lists under the Biosecure framework, warning it would, in their words, resolutely and forcefully retaliate. 9 days later, on June 2nd, the Office of the United States Trade Representative proposed a new 12.5% tariff on Chinese goods, stemming from a Section 301 forced labor investigation. One of two such investigations opened back in March that are set to conclude this summer. Layer on top of that, the Federal Reserve's own June meeting minutes, which revealed policymakers actively debating a rate hike before ultimately holding steady, with CME's FedWatch tool now pricing in a 63% probability of a September rate increase. Three separate institutional signals, three separate timelines, all converging on the same asset. Now here is the mechanism, and this is the part that determines everything else in this video, so follow the chain closely, because none of the later stages make sense without this piece first. Back in October 2025, China introduced sweeping export controls on rare earth elements, giving Beijing license authority over anything containing Chinese-sourced material anywhere in the world. That same regulatory architecture was then extended, quietly, to silver. Starting January 1st, 2026, Beijing replaced its old quota system with an approval-based licensing regime that hands export rights to just 44 pre-approved companies, each required to show a minimum of roughly 80 tons of annual production capacity and a strong balance sheet. According to reporting compiled from Chinese Commerce Ministry filings, this system controls somewhere between 60 and 70% of global silver supply. Before we get to the consequence, we need to understand the cause, and the cause is this. China did not build a silver export ban. It built a valve that can be opened wide during a truce and tightened instantly during a dispute, exactly the way it has already used rare earth licensing 3 separate times since 2025 as a pressure release mechanism in trade negotiations. This only makes sense once you understand that the licensing system itself is the weapon, not any single restriction inside it. So when tensions rise, as they did on June 13th, the market is not asking will China ban silver outright. It is asking how many of those 44 licenses get slow-walked, how many 45-day review periods quietly extend into 90, and how much registered COMEX and LBMA inventory gets strained as a result. Here is what most coverage of this story is missing entirely. Most financial media is still reporting silver's rally purely as a safe haven story, gold's cousin catching a bid whenever geopolitical fear spikes. But the Silver Institute and HSBC's 2026 Outlook data tell a different story underneath the headlines. The global silver market ran a structural deficit of roughly 230 million ounces in 2025 alone, driven by solar, electronics, and AI infrastructure demand that has no viable substitute at scale. That means silver was already tight before a single tariff headline this year. What the trade war does is not create scarcity. It weaponizes scarcity that already existed. That distinction matters enormously for how you should think about price behavior going forward, because a geopolitical thaw does not refill a structural deficit. It only removes one source of friction sitting on top of a shortage that was there already. Before we go further, if this is the kind of analysis you have been looking for, one that treats you as someone capable of following the actual mechanism rather than a headline, this is exactly why staying subscribed matters right now. The next licensing decision out of Beijing, the next Fed minutes release, the next COMEX delivery data point, these are the kinds of signals that move first, well before the mainstream headline catches up. I read every comment on these videos, and the conversation we build here is part of how I decide what to cover next. If you want to be positioned ahead of the next move instead of reacting to it after the fact, this channel is built for exactly that. Now I want you to be honest with yourself for a moment, not about the market, but about your own position in it. There are two versions of an investor holding silver right now. One version understands precisely why they hold it, can articulate the deficit numbers, the licensing mechanism, the specific conditions under which they would be wrong, and has a plan for what they do if China's licensing regime is extended peacefully past November. The other version is holding because the chart has gone up and the story sounds compelling, without any clear sense of what would actually falsify their thesis. This is not a judgment about which investor makes more money in any given month, because both can be profitable in a bull run. It is a question about what happens to each of them the first time silver has a genuinely violent 48-hour correction. One of them will recognize whether the mechanism has actually changed. The other will simply be hoping the number turns back around because they cannot afford, financially or emotionally, for it not to. So where does this actually go from here? I see three scenarios, and I want to be precise about what confirms each one. Scenario 1 is truce continuation. China's original rare earth suspension is set to expire November 10th, 2026, and if that suspension is quietly extended alongside the silver licensing regime staying business as usual, expect silver to trade in a relatively contained $55 to $65 range, driven mostly by the underlying structural deficit rather than geopolitical premium. Scenario 2 is licensing escalation. If the Section 301 forced labor tariff proceeds this summer as currently proposed and Beijing responds the way its June 13th statement threatened, watch specifically for slower approval timelines inside that 44-company export list, which would tighten COMEX and LBMA physical flow further and could realistically push silver into the $70 to $85 range as delivery stress compounds on top of existing deficit. Scenario 3 is a monetary policy override, where a September Fed rate hike, now priced at 63% probability by CME's FedWatch tool, pulls capital out of precious metals broadly regardless of what is happening on the trade front, pressuring silver back toward the $50 to $55 range, even if the underlying deficit remains unresolved. I am not going to tell you which of these is more likely. The data between now and November will make that clear, and that is precisely why this is a story you need to keep watching in real time, rather than checking back on once. I want to leave you with something that goes beyond price targets. China spent nearly a decade building a licensing system that turns physical control of a critical material into geopolitical leverage without ever technically calling it a ban. That is a different kind of power than tariffs, and arguably a more durable one. So here is the question worth sitting with. If the next generation of global leverage is built not on armies or even on tariffs, but on who controls the physical licensing of the materials modern life actually requires, what does real financial security even mean anymore? And is holding the physical metal itself a hedge against that shift, or just a different kind of exposure to the same underlying power structure? I would genuinely like to know how you think about that, so leave your answer in the comments, because that is a conversation worth having in the open. This is for education and discussion only, not personal financial advice. I am sharing a way to think through the history, the market, and the ownership questions, so you can make your own decisions with your own money and your own risk.